Joining us now with his thoughts on what China will do with its currency and the impact on the dollar and the euro is Michael Woolfolk, senior currency strategist and managing director of Bank of New York Mellon. Michael, welcome to you. So where do you stand? Should China be labeled currency manipulator, or as Jim O'Neill just told us, we're making much too big of a deal of the yuan and its valuation right now?
In no uncertain terms, Lori, should the U.S. Treasury label China a currency manipulator at this point? I take Rubini's point from earlier that certainly it appears that China is indirectly maintaining an artificial level for their currency, but nonetheless, by forcing them to move their exchange rate against the U.S. dollar would not have the consequences that the legislators in the U.S. would like it to have. In other words, creation of manufacturing jobs, even at the margin saving U.S. manufacturing jobs. It just simply wouldn't happen.
Now, Michael, what if China ultimately decides to let its yuan appreciate on its own a couple of percentage points?
Well, that quite likely is going to be the course of events, probably not near term, but it wouldn't at all surprise me if we see a move such as that by the end of the year or certainly into next year. I don't think that there's really any need to do so now. In fact, I see a win-win situation with President Obama in his State of the Union address saying we'd like to double exports within the next 5 years. You're not going to be able to do that if you're the United States without getting China involved. China has to buy more U.S. exports for that to happen. So I think the win-win situation is let the Chinese keep their currency policy as is in return for buying more U.S. exports.
Boy, the dollar is really coming out the currency to own these days. Would you agree with that?
Very much so. This week was a fundamental shift in foreign exchange markets, Lori. What we saw was a surprising positive reaction in equity markets to Sunday's vote for the health care reform bill. And then what we saw, even more surprising, was the fact that the dollar rallied despite the rally in equities. We've very rarely seen, since the Lehman crisis, the U.S. dollar go in the same direction as the Dow. We did see that this week, and interestingly enough, the dollar rallied not only against the euro but against the yen and across the board. Very unusual circumstances for a post-Lehman environment, and it suggests that market players are returning to fundamentals in foreign exchange rather than what we've seen since the Lehman crisis, which was really kind of a risk-off, risk-on type of scenario focused on the carry trade.
The dollar obviously benefiting from all of these problems, out of Greece. The euro getting hammered. It's back today. It's rebounded off that 10-month low against the dollar, but it's still historically low, 133.87. Let's move on to the euro and your outlook there. How low do you think, or do you think this is the low for the euro?
No, it could definitely head lower here, Lori. I think that the players in the marketplace now have shifted from being neutral dollars to being long dollars, and being long dollars, there's a ways to go. 130 is clearly in their sights right now in terms of the euro dollar, and I think they could do that within the next week. I think it would probably take much more than just merely positioning to get below 130 near term. It would require, I think, a further speculative attack on Europe, or perhaps even some fundamental negatives coming out of Europe for us to push much lower. But it would not be impossible to get to 125 by mid-year.
Great talking to you, Michael. Thanks so much. Michael Woolfolk is a senior currency strategist, Bank of New York Mellon.